everyone, this is Corey with Sims Investment Management. This is another monthly market update, and it is the middle of March 2025, and it's been a busy last couple of weeks for us here at Sims. Certainly, we're trying to navigate through tax season with everyone and help answer any questions that CPAs have and get the tax documents over. So if you still have any questions, please don't hesitate to reach out. We're also working through IRA contributions with CPAs and with our clients. So if we haven't gotten to you yet, you're still on our list, and we'll be working hard this last month of tax season. We've also been busy because let's face it, the last couple of weeks have been pretty controversial with the pure whiplash that we're all experiencing with the headlines. And so I want to hopefully present a couple antidotes and vaccinations for you guys today against the media. One of the first things that I want to touch on is I think this pullback recently, which the market is down roughly 9% or so from its February 19th high. So we're only 2 or 3 weeks away from when the market was making an all-time high. So the pullback has been, large. And there's a couple of reasons why. One is because some of the names that are in the S&P 500 are such large percentages of the S&P 500. So the top 10 names in the S&P 500 make up about a third of the market. So what that means is you have 10 names driving a third of the market, and you have 490 names that have to drive the other 2/3. And flat out, some of those other 490 names, they could be up. They're just not going to move the market as much as the top 10 names. And those top 10 names are Apple and Microsoft and Google and Amazon and Berkshire Hathaway and Meta and a lot of big technology names. And NVIDIA is certainly one of them, which has been a really big performer the last couple of years. And so you have large tech that is driving a lot of the market movement right now. I think it also feels a little bit bigger right now just because of the fact that it's happened so quickly. But we remind our clients that on average, every 12 to 18 months, the market typically pulls back roughly 15% or so from peak to trough, and then we recover. And so we're at about 9% right now. So we're technically under the historical average of what the market does in any given calendar year. So please just keep that in mind. I know it might feel a little bit worse right now, but from a perspective and from a historical standpoint, we're actually not even at the average intra-year decline. Let's talk about some of the emotion and psychologies of that. It's very human nature for us to want to react when we see these headlines, and especially now that everybody has a cell phone, that the headlines just keep buzzing them. And as human beings, we make decisions with the emotional side of our brain, and then we rationalize it after the fact. We actually do not make decisions with the rational side of our brain. And so I think it's very human nature for us to want to react and want to respond. But what we keep trying to stress to everyone is when you operate from a financial plan, and that's what we stress that we do with our clients, we are not market prognosticators. We are not market timers. We are operating off of your financial plan. And if you need short-term money, we're going to already have short-term money protected for you as long as you've relayed that information to us. And if you have long-term goals and needs, then we're going to have long-term investments for you. But we're going to operate off of your plan. And the only reason we see to change your investments or your portfolio is if your plans have changed, if your goals have changed. And then certainly we can talk through that. Now, that doesn't mean that there won't be some tactical asset moves that we can make in portfolios like we've done in previous pullbacks before. And our team's going to continue to monitor that. But as of right now, we are not over here running around like our hair's on fire, like I think a lot of clients think we are. We continue to operate and function and invest our clients according to their long-term plans. I'm going to go a little bit longer this month because there's 2 other points I want to make. This can be a little controversial sometimes when I ask this with clients, but Sometimes when I sense that clients have a heightened sense of anxiety, I ask them, how often are you checking your investment accounts? And more often than not, they say they're checking them pretty frequently. And study after study shows that the more often you check your accounts, the odds are you're going to be a worse lifetime investor. And think about it. If we use a very simple analogy of, if I'm trying to lose weight, but every day I drive to the bakery and I go in the bakery and then go get in my car and don't purchase anything, just by the mere temptation of driving to a bakery and getting out of my car and walking in and sniffing around and looking at the donuts, the odds are higher that I'm actually going to go buy a donut and screw up my diet than if I just don't go to the bakery. Similarly, if you're trying to stop drinking and you go to the liquor store every day, you're probably going to start drinking again. Or if you want to stop gambling and you go to the casino every night just to look around, you're more likely to make a bet. So the app is so easy, and I get that for clients, but it would be great if maybe we just try and take a break, maybe delete the app from your phone if you're feeling a heightened sense of anxiety and you're checking your accounts daily. I have yet to meet an investor that is a better investor because they check their accounts daily. It has not happened yet for any of the clients or anybody that I've worked with for over 15 years. The last thing that I want to say to prove this point is the main article of this newsletter, which talks about the crystal ball trading game. So a study was actually done in 2023 where they gave investors the opportunity to look at news articles that had already happened, and then they get to select what they think is going to happen in the market that day based on the headlines, the newspapers. So they've already got it. They're ready to try and predict what's going to happen in the market. And wouldn't you know that everyone that's played this game on average loses 30% of their wealth in just 15 trading days. So the future is unknowable. And at times the future is going to feel scary and uncertain. And at those times, the human nature is that we want to react and we want to do something. But there are plenty of times when we just need to stick according to our plan and trust that the plan that we put in place is the right one. We cannot judge policy based on one day or 1 month. We cannot judge policy based on what the market decides to do in any given day or any given month. And that doesn't matter if it's policies being implemented on the right side or the left side. It's the S&P 500, the 500 largest companies that are out there, and those leaders are making the best strategic decisions with our capital based on the information that they have. And we will continue to navigate what happens in the months and years ahead based on any changes that come to those leaders. So I hope this is helpful. I know it's a little bit longer. Please share this with anybody that you think might need to hear it. And if you have any questions, please do not hesitate to reach out, and we'll get back to you as soon as we can. Thanks.